As we are nearing the end of our class, there are a couple of small chapters that they're not irrelevant, but you're just not going to have a lot of deep questions on these, maybe only one or two questions, and they'll be very topical in nature. Those chapters are income taxation and basic investments. Pay close attention to the vocabulary, and we'll have a small test at the end so that you could get prepared for the type of questions you might get regarding these two chapters. Taking a look at our objectives, one of the objectives will be to explain common tax deductions for owners of personal residences, and the other will be to discuss the taxation of capital gains on the sale of a personal residence. I'd like you to pay close attention to that. Common tax deductions will be very specific about these. You're not trying to become an accountant, you're just trying to learn some basics. And then when we talk about capital gains treatment of a personal residence, please understand it might be different when you're talking about an investment property. And note that we tell you here that this information is literally for informational and instructional purposes only. We do not expect agents to walk out of this course and start giving tax advice based on these small chapters. The first question that we address has to do with what tax deductions are allowed for homeowners. Again, let me focus you on the word homeowners. For investment properties, completely different. But for homeowners, you will be able to write off such things as the interest and your real property taxes. So what we're talking about there is your mortgage interest and then your real property taxes on the actual property itself. Also, you're going to be able to write off discount points. Now, I don't know if you remember from the finance chapter that discount points are nothing but prepaid interest. So it does make sense that you would be able to deduct those from your annual taxable income. Now, this is an advanced level comment I'm getting ready to make, but I don't think that the test will go this deeply into it. When you pay discount points on purchasing your home, your personal residence, those are going to be completely tax deductible. If you refinance somewhere down the road and you pay discount points at that time, they would have to be spread out over the course of the loan, and they would be a much smaller deduction. Might not even be worth paying discount points for a refinance. So to wrap it up, just take a look at your slide here. It tells you everything you need to know about common deductions on your personal residence. Your mortgage interest, your discount points, and your property taxes would be the three things that you want to remember for test purposes. Congratulations, you're already halfway through this topic because notice that we're already on the second objective by this point. We're going to talk about capital gains treatment when you sell your home. Again, focusing on this is the sale of your home, not an investment property. Okay, what we're giving you here is actually a small formula. The amount realized minus the adjusted basis equals capital gains. Now, you might not know what these words mean yet, but just write them down for right now. Amount realized minus adjusted basis equals capital gains. Let's go a step further and let's talk about some things and what some of these words mean. Okay. So to calculate your amount realized, now remember, amount realized minus adjusted basis equals capital gains. So to find the amount realized, here's the formula that we're going to use. Keep in mind, capital gains are not an issue until you sell your property, right? So when you look at this, sell price minus allowable closing costs. Let's keep it pretty simple, actually. Let's assume that the allowable closing costs on the sell side would include the three things we know that the seller pays. The seller pays for the commission, the seller pays excise tax, and the seller pays for like deed preparation. So it's outside of the commission, it's not really a lot. So if you sold the property for $400,000, you paid the agent $24,000 in commission and another $1,000 in closing costs. It sounds like to me like we deducted the $24,000 minus about another $1,000 or so. I didn't do the calculation in my head, but you would deduct that from the sale price of $400,000. So you would lower your amount realized to whatever that came out to, $375 or whatever my math was on that. That's how you calculate the amount realized. I would like to focus your attention on a theme you're going to see run throughout this. When we're talking about adjusting these numbers, you're never going to make adjustments for maintenance or repairs. That's considered a day-to-day operations, and you're not going to be allowed to deduct those expenses. Okay, we just found our amount realized. So let's look ahead and let's see if we can figure out how to calculate our adjusted basis. Now, on the adjusted basis, what you're looking at here is what you have in the property. And when I say what you have in the property, notice it starts off with basis. I have already looked ahead at the next slide. I know that we're going to define basis in detail, but I want you to think of that as what you had in it, the purchase price plus allowable closing costs. The allowable closing costs are actually defined in IRS publication 523. You don't need to look that up. You don't need to worry about it for the exam. Just trust us on this. There are some allowable closing costs. So your basis is going to be what you paid for the price, the purchase price, plus the allowable closing costs. Now look at the third thing that you can add here. You can add in your capital improvements. Let's say over the course that I've owned my home, that I have added a garage to it. At the time that I bought it, it did not have a garage, and I added a garage. That's considered a capital improvement. I've done something to improve the value of my property. Okay, I can add that to my basis, so it looks like I have more in the property. Now, I don't know if this resonates with you yet, but hopefully you understand that when I'm talking to the IRS and I'm dealing with capital gains when I sell my home, I wanted to make it look like I didn't realize that much. So remember, we took what we sold it for and we subtracted out the closing costs. We try to get the amount realized as low as possible. And notice on the adjusted basis, what I'm trying to do is make it look like I had a lot of money in the house. What I paid for it plus closing costs plus capital improvements equals my adjusted basis. Capital improvements would also include things like special assessments that I was charged by the county. For example, if they bought me a water and sewer line, charged me $14,000 for it, I could adjust my basis on that. So what we're trying to do is pinch down the capital gains to make them as small as possible, so there will not necessarily be a tax consequence for that. Again, look down at the bottom of this page and let me remind you, capital improvements are not normal repairs. Normal repairs and maintenance maintain the value of the house. Capital improvements improve the value of the house. Okay, so we've defined amount realized, we defined the adjusted basis, and let me remind you, that's your definition of capital gains. Amount realized minus adjusted basis equals capital gains. Investment property, it just popped in down at the bottom, completely different way of dealing with this. And so we'll worry about that in a later part of the lesson. I told you on the next slide that we would define what the basis is, and for our purposes, the fact is that basis is going to be treated as the purchase price. That's what I had in the property at the beginning, was the purchase price. Very important slide right here. Now, you're not an accountant, so you're not advising anyone on this, but you might be the deliverer of good news occasionally. And the market that we are currently in at the time that I'm making this video is a very hot appreciating market. So we have people that bought property. I saw one today. Someone bought a property 4 years ago for $395,000. That property today is worth $595,000. Over the course of just 4 years, they made $200,000 on that property. That could create a major tax consequence if there's not some protections in place. Well, let me remind you, if that is your home, there are some protections in place, and this is what those protections are. I'd like to focus you on the left-hand side of this slide and notice that if you have lived in this property for 2 out of the last 5 years as your primary residence, now notice that's 2 out of the last 5 years. It could just be 2 years consecutively, or it could be that you lived in it 1 year, moved out for a couple of years and rented it out, and then you moved back into it. As long as you meet the 2 out of the last 5 years threshold, it can count as your primary residence. And the benefit of that is you are going to be able to avail yourself to what's known as the universal exclusion. And notice what that exclusion is. I'm going to start at the bottom. If you are a single person and you own that property and you sell it and you make $250,000 or less in gain, it doesn't matter what you sell it for. You can sell it for $1 million, but as long as your gain does not exceed $250,000, you're not going to have to pay any capital gains tax on this property. Look at this. It gets even better if you're married. If you're married filing jointly, The gain that you can exclude is up to $500,000. This is one of the great perks that comes with home ownership. Your ability to be able to sell this property, you can pocket the money, you can put it into a new property if you want to, but as long as you meet the universal exclusion, you've lived there 2 out of the last 5 years, you didn't exceed 250 single or 500 as married filing jointly, you're not going to owe any capital gains tax at all on that. Make sure that you memorize this slide in preparation for the test. And again, congratulations. We have just navigated through the tax benefits of home ownership, what you can write off of your taxable income, and then capital gains treatment of home ownership. Okay. Well, now we're going to go into investing a little bit. That was your primary residence. We're now going to talk a little bit about your investment properties. But let me remind you, this is not the class that we're going to do a deep dive into this. It's going to be very topical. It's going to be very much vocabulary oriented, and you're just to get the information that we have on these slides for you. So what we're going to talk about first is we're going to explain the basics, underlying basics of a 1031 like-kind exchange, and then we're going to define basic real estate investment concepts or terms. Okay. Interestingly here, if I own an investment property and over time I have gained on that property, there's two things that occur on an investment property. One is you hope it goes up in value. As the income on that property increases, it probably increases the value of that property. But also when you own an investment property, you can deduct certain depreciation on the property if it has an improvement on it. In other words, land is not depreciable, but if you have an office building on it, that property would depreciate over 39 and a half years. What I described to you was a commercial property. They depreciate over 39 and a half years. If what you own are residential single-family home rental properties, they depreciate over 27 and a half years. It's a straight line depreciation, and it provides a great tax benefit for you during the year that you're paying taxes on your income. Well, here's the problem with the depreciation. The IRS will allow you to depreciate on your investment properties. However, at the time you sell it, the IRS wants to recapture the taxes on that property that depreciated. So you could be looking at a decent size tax bill if you do not have a strategy. So here's the most important point that I want you to take on this slide. 1031, like-kind exchange, is a tax strategy for investment property. 1031 is a tax strategy for investment property. Now, you'll hear people talk about it. Some people will call this a 1031 tax-free exchange. Don't call anything tax-free. The IRS doesn't give anything tax-free. But if you use this strategy effectively, you might be able to avoid taxes for a long period of time, potentially forever. I often tell people when it comes to investment properties, you never sell an investment property. What you do is you exchange it, and then you exchange that property and exchange that property, and then you die. If you die owning the last property, you beat the IRS, because when your heirs inherited, they inherited at what's known as a stepped up basis. And so they would not have the tax consequence that you had carried over those years and deferred. Okay. So I don't need you to know a ton of information about this, but the idea of an exchange is based on the concept that when you sell a property as an investor, you never actually touch the money. If you don't touch the money, you don't have to pay taxes on it. So notice in this particular case, we have a seller that owns an investment property. They decide to sell the investment property. Let's assume it's some type of commercial building there from what it looks like. It doesn't really matter. What matters is the definition of it is being used as productive business use. In other words, they own this property for income purposes. Okay, so they decide to sell their income producing property. But notice what I told you is that if the seller touches the money, they have to pay taxes on it. But in a 1031 exchange, what the seller is going to do is they're going to identify a third party. This third party is known as a qualified intermediary. You see the qualified intermediary or QI at the top there in red. So when the property is sold, the proceeds from that sale go to the qualified intermediary. And what the QI is doing is they're holding that money for the purchase of another property. In other words, when you do a 1031 exchange, it's not like you're finding another property and another seller and saying, "Hey, let's swap properties." It's never going to be quite that clean. What happens is you end up selling your property, you don't touch the proceeds, and then you buy another property, and the QI would take that money and put it into the new property. So in other words, you never touched it, you never had to pay taxes on it. Now, because this is the IRS, there are going to be rules. And again, you're not learning this to go out and teach people as an accountant. You're learning it to recognize it if it shows up on a test. So if it shows up on a test, I want you to be familiar with a couple of rules about a 1031 exchange. One of the burdens of the seller, once they sell their property, what we call the relinquished property, when they sell the relinquished property, they have to find a replacement property within 45 days. Now, when I say they have to find it, they literally have to identify the property. And there are rules. There are rules about how many you can find. That there's like 3 options that you have when you're identifying replacement properties, but your accountant can explain all of this to you. So don't worry about getting bogged down in those details. Here's the most important thing that I said. When the seller sells the property, they have 45 days to identify the property that they're going to exchange their profits into. Okay? Now, once they've identified the property within that 45 days, they must close on that property within 180 days. Now, I don't want to confuse you by the way I said that. The 45 days is subsumed within the 180 days. In other words, it's not like you identify the property and then your 180 days start. Both the 45-day count and the 180-day count started when the seller sold the relinquished property. So what do I want you to remember on this slide? I want you to understand that a 1031 is a tax strategy for investment property. Boom, check 1. All right. I want you to understand the role of the qualified intermediary. When the seller sells the relinquished property, they don't touch the money. They put it with the qualified intermediary who is holding it until they close on the replacement property. I also would like for you to recognize that the seller now buyer, now that they've relinquished their property, has 45 days to identify a new property and 180 days to close on that property. It is important that if your clients effect a 1031 exchange, that they follow the rules very, very closely. Because keep in mind, if they don't follow the rules closely, they're going to be hit with capital gains taxes on this, which could in fact be very consequential depending on the amount of gain that you had on the property. So 1031 like-kind exchange, vocabulary for this particular test in the field, please learn who a good accountant is, who handles this type of transaction, and get to know where you can find a very qualified, successful, and helpful qualified intermediary. We had mentioned that there was going to be some vocabulary. Just because it's vocabulary in the investment chapter does not mean it's hard. Okay, so let's look at our first word here. Our first word, vocabulary word, is equity. And that's kind of been a running theme throughout our class. So this is not really a new word to you. You just want to put a definition to it. Equity is going to be the difference between fair market value, how much your property is worth, and the debt that you're carrying on that property. So I own the property that has a value of $500,000 and I have a loan on that property for $250,000. Well, my equity is $250,000. Okay. Now, equity is the basis for things like home equity lines and being able to borrow money against your property. And we will talk about that significantly here in the next slide. I would like to mention 3 things to you, though, that you would just want to write them down maybe in your margins here. A good test question may go to the idea of how one increases their equity. Well, the way you increase your equity is through appreciation. Your home goes up in value. That's fantastic. Okay. You also increase your market value through amortization. As you're paying your loan down, remember the definition was fair market value minus debt. If you're paying your debt down, that is increasing your equity as well. And then another way that you can increase your equity is through capital improvements. When I built that garage, it cost me $14,000 to build, but it added $28,000 in value because in this area, people are willing to pay $28,000 more if it has a garage attached to it. So those are the three things that increase your value. Watch out for trick questions like this, though. Maintenance does not increase your value. Maintenance maintains your value. Capital improvements has the possibility of increasing your equity. We mentioned the word appreciation just a moment ago, and if you want an official definition of appreciation, appreciation is the increase in value of a property over time. That's all appreciation is an increase in value. It's the opposite of depreciation. Depreciation would be a loss of value over time. There's your definition there if you like that. And then the concept of leverage. When I think of leverage, I think of using other people's money. Now, this is one of the neat things about real estate. If I need to buy a property for $500,000 in real estate, I don't have to come up with all $500,000. Normally, I come up with a percentage of that, maybe 10% down, 20% down, maybe 25% if it's an investment property. And then I use other people's money, typically a lender, or if you're in investment properties, it could be some type of hard money lender, a hedge fund, or something like that, depending on what it is that you're buying. But the definition of leverage is just simply using other people's money, using debt to buy assets. Okay, so you see that definition that just popped in there. Leverage. Now, I do want to put all these out there for you. This slide, what you want to keep in mind on this slide is what this slide is telling you. The positive and the negative of owning real estate. In fairness, we always talk about the great things because it's a real estate class. We always talk about the great things associated with real estate. We don't always talk about the negative. This slide talks to you about both. One, we'll talk about the rate of return. So when we talk about the rate of return, if I put up $100,000 to buy this $500,000 property and it cash flows every year by $20,000, some people may look at that and say, $20,000 on 500 grand? That really doesn't seem like that much. Oh, but remember, I only came out of pocket $100,000. So the fact of the matter is, if I made $20,000 on a $100,000 investment, it's a 20% return. So your rates of return can be high on real estate if it's purchased right and if it's leveraged correctly. And then, of course, you see the next word, leverage. We've already given you the definition, using other people's money to acquire assets. This is an advantage that real estate has over like buying stocks, for example. If I'm buying a stock, if I'm buying $500,000 of stock, I typically need $500,000. If I'm buying $500,000 of real estate, I can possibly buy it with maybe $100,000 and then I would just borrow the rest. Control of real estate is a big deal because if I control the property, I can affect its value. For example, if I buy a house that has 3 bedrooms and 1 bath and I add a second bath to it, I've created substantial value because now I've created a product that the community needs. The 3.1 may have been a little bit functionally obsolete, but a 3.2 is very desirable in a potential neighborhood or in a neighborhood potentially. Tax benefits, we've already talked about that. We started in this chapter saying that the tax benefits of home ownership, I'm going to be able to deduct some things from my taxes, from my income tax. And then when I get ready to sell it, there are capital gain strategies. And to be honest with you, there are capital gain strategies regardless of whether you bought it from your personal need and use the universal exclusion. And there are tax benefits on investment properties if you use a 1031 strategy to help you build your portfolio over time. And then, of course, cash flow. If you wanted a definition of cash flow is just simply what you have left over after you've paid all of your bills. You have income, you have expenses, and then you had your debt service where you paid your mortgage. But anything that's left over at the end is cash flow. Now, cash flow, I can't guarantee it's always going to be promised. That's always going to be positive. This is going to be a function of whether you purchased and financed the property correctly. But having said that, there are times when you have a property that may cash flow negatively, but ends up being net positive because of the other benefits that we mentioned, for example, the tax benefits and appreciation. Okay, there's always bad news. So let's look below the line. When we start looking at the words in red, These are going to be some of the negatives associated with owning real property. First of all, it's not liquid. And what I mean by that is if you own a property and you have equity in that property and you need money tomorrow, it's going to be tough to get it out of that property. You're either going to have to sell the property to make it liquid, to turn it into cash, or you're going to have to go out and borrow money against it to turn that into cash. Both of these things are not immediate. Certainly selling it could take a long time. Borrowing money is going to be more efficient off of it, but even that has a time delay in it before you can access the money. Notice also that real estate requires active management. I would encourage you, if you're buying investment properties, that one of the things that you calculate into your summaries is the ability to pay a property manager. A lot of times people buy investment properties thinking that they're going to have this income coming in, everything's going to be beautiful, and they'll take care of it if anything comes up. And then they realize they don't have a heart or a stomach for property management. It's hard to kick people out of a property. It's hard to get a call in the middle of the night saying that you need to go over and fix a toilet or something to that effect. So some people do not love the concept of active management. Even if you have a property management company and you're receiving passive income from that property, someone still has to make decisions. When do we replace a roof versus put a few shingles down? When do we have to replace an AC unit versus patch it up? These things require the owner to make decisions on that. And then, of course, all real estate does have some risk. So the question you ask yourself is, how do you manage the risk? Well, you buy insurance. That's one way. You might own investment property through an entity like an LLC to make you immune from lawsuits, for example. And then you maintain the property so that there's not as much risk of someone being injured on your property. But at the end of the day, there's always going to be risk. What was this slide telling you? These are not hard concepts here, but understand the positives of owning real estate, but recognize as well there are negatives associated with owning real property, especially if you're using it for investment purposes. A few math questions that come up in this chapter. I would encourage you to just kind of look at these and understand the process here. Basically, what we're looking at in this question, I'll just read the question. If you buy a property for $200,000 and sell it for $245,000 2 years later, what was my percentage gain? Well, as you're calculating this problem right here, the first thing you want to ask yourself is, well, what was my gain? Well, if you bought it for $200,000 and sold it for $245,000, do not imply any tricks here for test purposes. In other words, don't start thinking in your head, well, how much was my mortgage payment? What did I have to repair over that period? Don't do it. You bought it for $200,000, you sold it for $245,000. You made $45,000. You made $45,000 on a $200,000 investment because that's what you had into the property. So let's see how the maths out on this. You're going to take the new price of $245,000, subtract the old price of $200,000, and then what you will find is that's $45,000. Look at the second line there. Your gain was $45,000. You're going to divide that by the old. I would really call that the original is what it amounts to, the original price that you had. And what you'll see in this case is your gain on that property, given those terms, was 22.5%. That could be a math question for you. And I got to be honest with you, that's as hard as it's going to be. So if you understand that concept, you're in really good shape. Now, if we wanted to turn it negative, what we would do is we could ask you the same question, but in this case, we could ask it from a loss standpoint. But it's the same question. If I purchase a property for $450,000 and sell it 3 years later for $375,000, what was the percentage loss? Same strategy here. You bought it for $450,000, you sold it for $375,000, you lost $75,000. Okay, so we take the new price of $375,000, we subtract out the $450,000, and you'd find, of course, that's a $75,000 difference. We're going to divide it by the original price. This is the one that confuses some people because they think that they're going to divide it by the small number. Well, unfortunately, in this case, you had a loss, so you're going to divide it by the large number of $450,000. So let's see what it looks like. $75,000 is your loss. It doesn't matter if it's positive or negative. When we're talking percentages, it's just going to be the percentage of the loss. $75,000 divided by $450,000, which was your original purchase, comes up to 16.7%. So you lost 16.7% on that purchase. Just going to hit on these review questions real quickly for you. Here's what you were to pick up in this little chapter, these two little chapters here. What does the basis represent? Well, as I'm studying for the test, what I'm always doing is I'm trying to relate. So I see the word basis. In my mind, I'm thinking this has something to do with taxes, and it probably has something to do with capital gains treatment. So what does basis represent? Oh yeah, basis was what I had in the property. Okay, and then remember when we're solving this for on our personal property, it's our adjusted basis. I didn't go into detail on the capital gains treatment of investment properties on how basis is determined, but there would be a basis in that calculation as well. A little more difficult to ascertain. Question number 2. A married couple sells an investment property with a gain of $550,000. How can the couple avoid paying taxes on their gain? Well, the first time I read this question, I got in too big a hurry, and I missed the obvious important comment here. Married couple sells an investment property. When I saw the $550,000 gain, I'm like, crap, they're over their $500,000 exemption, so they're going to have to pay taxes on $50,000. But when I went back and read it, I said, oh, this is an investment property. If they don't want to pay any taxes on the gain right now, they need to do a 1031 tax-deferred exchange and roll this profit over into another property, in which case the taxes would be deferred and they won't have to worry about them until sometimes down the road when they either sell the property or, as I said earlier, if they continue to exchange up to the point where they pass away, then their heirs will actually inherit the property on a stepped up basis, and some of those deferred taxes will be forgiven. And then finally, what are the deductible expenses on a married couple's tax return each year for real property? At this point, let's kind of narrow it down to the 3 obvious things. They can write off their mortgage interest on their primary residence. They can write off discount points that they paid at the time of the purchase, and they can write off their real property taxes. And that's it. It's just a nice, tidy couple of little chapters here. If you understand those concepts, you're going to do amazing on this. I'll send you some test questions on this so that you can practice, so you'll see what they look like in actual question format.